Great. Good morning, everyone. I want to be respectful of everyone's time, and I would like to start the meeting. I'm going to start with a land acknowledgement. We would like to begin by respectfully acknowledging that the town of Shelburne resides within the traditional territory and ancestral lands of Anishinaabe, including the Ojibwe, Potawatomi, Chippewa, and the people of the Three Fires Confederacy. These traditional territories upon which we live, work, play, and learn are steeped in rich Indigenous history and traditions. It is with this statement that we declare to honor and respect the past, the present connections of Indigenous people with this land, its waterways, and resources. Welcome, everyone. I'd like to introduce Karen Webster. She will be leading the presentation this morning. Karen Webster is a chartered professional accountant, and she's the senior manager of RLB, Chartered Professional Accountants.
Thank you so much. I appreciate everyone getting up early and being here today. It's not the most exciting topic in the world to talk about, but it's a very important one. And so I'm happy that you're all here and you got up to listen to this presentation this morning. And I just want to confirm that you can currently see the screen showing succession planning.
Yes, it's clear.
Perfect. Thank you. So we'll get started. What is a succession plan? Basically, a succession plan is transitioning your business to a new ownership, to somebody different than yourself. That's really all it is. And for lots of people, it's scary. People don't want to talk about it. They don't want to think about it. It's kind of like doing your will and estate. And you just put it off, but it's very, very important. As we'll go through today's presentation, you'll realize that it's good to plan, and we'll look at different aspects of why you should plan for leaving your business. And I just wanted to point out, as we're coming into fall, planning is no different. There's no one plan that fits all. It's not like what works for one will work for another person or another business. It's different and unique for each specific business based on the needs of that business, what your family dynamics are like, what that business is like. Depends on if you're transitioning to someone outside your business or within your business. So there's lots of different aspects, and it's always important as you're thinking about this to talk to your advisors, the people in your circle, your accountants, your lawyers, and get them all on board, get those on board that you're considering transitioning your business to. And talk to them because, as we walk through this, you'll see that sometimes you may have a key employee that you feel would be great to take over your business. You have that in your mind, but it might not be in their long-term plans. So it's important to consider all aspects as we're going through this presentation today. So here's kind of the agenda for this morning. We'll talk about why you should put a plan together, when should you start planning, where to start, what are your options, and then we'll have some questions and closing remarks. And certainly if you have questions throughout the presentation, please, I'm an accountant. I do not like to talk a lot. So by all means, put your hand up, interrupt me as we're going through. I'm completely fine with that. We have a small group this morning. So that is perfectly fine with me. If you want to, or stick it in the chat, you can send me a message after the presentation as well, if you would like. That's fine. So yeah, just please feel free to interrupt me or jot your questions down and we can discuss them at the end. Just some fun facts here about family-run businesses. Usually that's what we're dealing with. So Cargill is the largest private family business with 1.2 million in revenue. Walmart, interestingly, is the largest public family business at 444 billion in revenues. And then there's a Japanese hotel chain, which interestingly has been running for 53 generations, which is quite phenomenal. That legacy continues on generation after generation, and it doesn't go without planning that happens. So just some, quick reasons why you should consider planning. I mean, planning was involved when you started up your business. You likely had to do a business plan. You had to talk to the bank. There was lots of things you needed to consider when you were starting up. So it's no different when you're transitioning out. You need to put the same kind of time, energy, and resources into making sure that you're getting the most out of out of the years that you've put into your business. You've worked really, really hard to get to where you are. So you want to make sure that you're doing everything you can to get as much out of your business as you can. And kind of along the same lines, you had a vision, you had goals, you had dreams. Those changed as you were going through your business, and you may have changed them very recently. And, as you're thinking about retirement, it should be the same. You should really, really consider, what does your retirement look like? What is your goal for 5 years down the road, 10 years down the road? Really think about those kind of things and visualize what that looks like for you. And sometimes as you're visualizing, there's other things that pop into mind. There's certain things that you can think about that you haven't thought about that may change your plan or how you transition out of the business. And, just to the point earlier, you've worked very, very hard to build that business and make it successful. And it's a legacy that you want to leave behind. So, you know, y- as you grew through your business and your business grew, your strategies changed, the plan evolved, maybe got a little more intense. It's the same thing when you're exiting. You should never just say, okay, I'm done, walk up, close your doors and you're done. Because you have put a lot of time and effort into your business. So there's likely a plan there for you as you're considering exiting. And it's something like, they talk about the elephant in the room with regards to estates. It's the same kind of thing. You think about exiting out, and you may not have a child that may wants to take over, a dependent that wants to take that business over. So you just put it off because you're like, I don't want to deal with that right now. I don't want to think about retiring. It means I'm coming to the end of my life. It may be depressing, it may be sad, but you've got to think about it as, you've worked very hard to get to where you're at today. Be able to enjoy life and be able to get the most value out of the business that you have. And you maybe have had a successful life from the business. But you want to transition that on and leave a legacy behind. Continue that on as long as you can. So that's important. So it's important to start talking about it, and start talking about it with those that you feel like you want to have that conversation with. And that may be family members. It may start with your spouse. And sometimes even in estate planning, you don't necessarily, you might think you're on the same path, but you're not. So it's important to get those conversations started. And if you have family members you want to be involved in the business, then talk to them. Make sure that they're interested in that. Same if it's a key employee or someone from outside your business that you're thinking about, having them transition over. So talk to those people, and then also talk to your tax professionals, your accountants, your lawyers. And you may have to talk to your bank as well. There may be certain leases and loans associated in your business that may have to be transitioned over as well, depending on the structure and how that's all set up. So there's lots of things that you want to try and consider as you're dealing with this succession plan. So some of the key factors when you're talking about a succession plan, and one of the main reasons, or a few of the main reasons, I should say, that you would want to start early and make sure that you have a plan in place is tax efficiencies. That is one of them, and that planning ahead can provide the most. After tax dollars for your retirement. So certain things like the capital gains exemption on small business shares, you'll want to make sure ahead of time that you're qualifying for that. That's a big deduction currently at 456,000 deduction limit. That's the actual savings for tax purposes that you can get if you plan ahead and make sure that your shares in your small business corporation qualify. And there's certain criteria for them to qualify. So you want to make sure, in order to get those tax efficiencies, especially, that you're looking after that and you're sheltering as much of the income that you've created and built up in there for your long-term gain. And it may be that you've had an extremely successful business and you want to, end up deferring some of that tax. And we may do what's called an estate freeze, which means basically that you're pushing the equity up to a different class of shares, generally a preferred class of shares, which that money can be paid out to you potentially over time. So instead of, selling your business in 1 year and creating, over 50% tax bracket for yourself, you may be able to stream that a little better and plan ahead and potentially, stay in a 30 to 40% tax bracket. Um, and so that's the tax deferral option, which is beneficial, especially if you can push some of that tax into future years. So you can work with your tax professional, and you can actually see in a planning how much tax can be saved if you were to sell today and take all the tax associated with that in 1 year, or if you were to push that out over several years, what that plan would look like for you. And sometimes the tax savings can be huge. So it's very important to make sure that you have time to look at and make sure that you're doing the tax efficiencies and the tax deferral. The other things you want to be able to consider is, who you're looking after sending, leaving your business to when you retire. Do they have all the adequate skills that you have and you've built up over, 20, 30, 40, 50 years, that it's taken you to build up those skills and expertise in your own business? And is that something that, if it's your dependent, your son or daughter that you're thinking about leaving your business to, do they have all the skills necessary to be able to do that? Do they have people skills? Do they have that leadership development to be able to do what you do on a daily basis? There may be things that, you just haven't considered. And it may be something as simple as, you know, you may come in to your office in the morning and turn the lights on and unlock the doors and get everything all set up for the day. And maybe they've never even had the opportunity to do that. I know it's very simplistic, but what happens if something happens on a weekly basis, that the trash goes out, they don't know where to put it, those types of things. And those aren't necessarily skills that you would need to run your business, but there's lots of little logistics within a business that um, you know they really need the time to be able to shadow you for, every business is different, but they should be able to shadow you for a little while to make sure that you're not missing anything. And I'm sure you all can think of things that have come up in your business that potentially that they might not know on a daily basis. So it's important to make sure that they have those skills. And you have to really look at your business and, are you dealing with people every day? Is that person able to do that? Do they like dealing with people every day? What happens when you have a difficult customer or client? Do they have those skills, or do they just throw up their arms and walk away? So those are really important things that you need to consider. Um, the other thing to consider is, if you're looking at an ideal successor, they may want to know your business. They may want to um, again, know what's happening. Planning allows you and your network of advisors time to look for that perfect ideal successor and implement a transition plan, so that your business can continue to run the way you've set it up. Chances are that you've been running this business for a while, so you know what works and what doesn't work. Share those resources and share that information, because lots of time we have it up in our heads. It's not necessarily down on paper. And I remember in my old 4-H days, you learn to do by doing, and in lots of cases, that's exactly what your business is like. Is that you've built up this legacy, and you want it to continue, and you want your business to be successful for the years ahead. So you want to make sure that that ideal successor has that, um, the same attributes that you do, and are able to carry on year after year as you have. And basically, so for your customers and clients, like if you're running a restaurant, they would see no change. And that's really what you would want, is that transition to happen easily. And then one of the last, but not only, considering factors is allowing enough for adequate funds and resources. So the person buying your business may not have that kind of cash on hand, just lying around. They'll have to have a plan in place. They'll have to be able to have time to go to the bank, and sometimes that takes a while. It takes a while to have that set up. It may be that they have to sell something else before they're able to have the funds to be able to purchase the business. And that changes regularly, right? As interest rates are rising, and the banks are tightening their strings, you may have to look for another source of funds to be able to finance um, the structure going forward. So all things that need to be considered. Um, Along with, you want to make sure that you have a contingency plan. You may want to retire in 5 years, but you run into health problems, or you may get another offer from outside. So your plan needs to be flexible. You need to be able to, have at least enough thought process put into it that you know what you want to do. It's kind of like, when you're selling your house, you have an idea of what you what you want for your house, what you need to do before you do that. There's going to be some planning ahead. You're going to have to clean up some rooms. You may have to sell some of the stuff that you've got in your house, or maybe you're not selling it, maybe you're getting rid of it. So as much as you would do that with selling a house, you would do the same here, is that you're going to think about all the things that you need to do. Maybe you have a box of records in one of your storage rooms that, has all your personal tax returns from the last 60 years. So you really need to think about, you don't want to transition that to a candidate from outside of your business. You need to deal with that. So it's the same kind of thing. And that plan needs to be, you need to have proper timelines in that to make it realistic for yourself. So, you're not going to say, I'm going to sell my business tomorrow, because likely, it's not going to transition smoothly. You may have a great offer come in, but you have to give yourself enough time, your staff time, to make sure that that's going to happen, and that will go forward as you had planned for it to go forward. And then also having the last thought here is having peace of mind. You plan ahead for, when you pass away. You plan an estate to make sure that what you have as far as assets go, that those can be transitioned to appropriate family members. So it's the same thing here. It kind of gives you a peace of mind that things will be left the way that you're thinking they will be left. Now, you also have to understand that when you sell your business, you're also selling the right to run that business. And that may change depending on how the structure works, but generally, that's what's happening. So you want to make sure that you're taking the time to think about your wishes and the financial needs upon retirement. And that can really help you plan accordingly. You want to have those open discussions with your family, key key employees and then your advisors, which may raise some other other issues, some possibilities that you haven't even yet thought of. And it may raise some strong emotions. And we'll get into that a little bit as well. As you may have, let's say you have two children and you're passing one on to the business. You're passing the business on to one, the other one is successful doing something else. And how does that look for both of them? Is that fair and equal? Does that make the same uh, impact as if you were in your estate to leave them each a chunk of money? Likely not. So it's always good to remember that fair may not always be equal. And you may have built up a viable business, which is continuing. They just walk in. Let's say your business is making 200K a year, um, and that's enough income for them to live on annually. So they just, they walk in, take over your business, and boom, they have 200,000K a year coming to them. That you know they didn't really have to do a whole lot. They may have been in the business, or they may have just walked into it. How's that fair to their other sibling, who may be, gone to school, took a university degree, got into engineering or something, and they're making 100,000 a year? Is that fair for them as well? So all things to consider, and it's important to include all of those family members in and outside of the family, or make sure that you're, thinking about it from all sides and that it's equal. If it's not equal, then there's other ways that you can talk to your advisors about helping to make it equal. So when should you start planning? It's really never too early. You should start thinking about some of the things that are important to you. And what's important to you today might not be important to you, 5 years down the road. But it's certainly something to start thinking about. Planning in the early stages, as we talked about earlier, can provide for sizable tax savings. So that's something to think about. You want to make sure you have time to find the right person for your business. So, in saying that, we talked earlier about, you may think that you have a key employee that may want to take over your business. And unfortunately, when you approach them, they may say, yeah, no, I don't want to do that. I don't want to run the business. I don't want to be the face of the business. That's too much. I'm not interested, or I've decided to pick up roots and our family is moving. And you may not have known that. So um, it does take some time to be able to plan that. You want to make sure that whoever you're transitioning that business to, that you give them the opportunity to talk about it, because it's likely a big decision for them as well. They'll need to talk to their families, and is that something that they want to do? And then just reiterating the fact that there'll be cash probably changing hands. You'll need to make sure that there's time to generate that cash for those, not only for those coming into the business, but also for yourself as you're exiting. How much money do you need on a monthly basis, on an annual basis going forward? And you want to make sure that you can provide for that. You may have RSPs and other forms of revenue coming in, but you may also be relying on the revenue coming in from the business, the sale of the business, and making sure that that's providing enough for you to be able to have your dreams come to fruition. Depending on what that is, you may want to be in the sunny south for the winter. So, what does that cash look like, and how much do you need on a monthly basis? Um, you may run into some complications, which we spoke to earlier, about family members and the structure of the of your corporation. You may need to create new classes of shares. So you'll work with your lawyer in order to do that. So those types of things take time. It's not something that can just happen, in a week. They take time to be able to prepare and make sure that that length of time covers for complications. There may be a death in the family, or an illness, or something that may prolong that. So it's good to make sure that you have enough time. The other thing to also consider is, we talked about, if you sell your shares, You want to make sure that they're going to qualify for that capital gain exemption. That's a huge amount of tax savings that you can have there. So you will need to have made sure that you have your shares for 24 months prior to the sale. You'll need to make sure that there's other qualifications that happen. So you need to hold those shares for 24 months prior to the sale. You need to make sure that they qualify. If you have assets that are being used in the business, they need to be used actively for 24 months. You may have real estate sitting in your active business income, and you may say, "Ooh, I don't know if I want to sell that real estate. I may want to hold on to that." And that may be my income coming forward in the future as well. And as we've seen, the markets have drastically changed over the years, and that piece of real estate that you may have purchased years ago for 30,000 may be worth a million or more now. So it's important to look at that with your tax advisors and determine maybe we want to move that real estate out of the active business and move it into another corporation so that you're not selling that as part of the corporation, but you're selling it separately, and you still can then control when you sell that. You can still control if you're renting that out, even though your business may close down or someone may take that over. You may want to keep that real estate in your own hands. So it's important to look at that. It's important to look to make sure you don't have excess cash sitting in your business, because that may disqualify you from the small business capital gains exemption. If you're looking to sell to an outside buyer, you may need several years of financial statements in order to do that. They may need to look and say, "Oh, this is a viable business. They're making 500K a year. So, if I'm putting in 2 million, I can turn that around basically in 4 years," is very simplistic. So, they may say, "Ooh, that's great. Was that only COVID that did that? Or is that their standard?" So they may want to look to financial statements prior to 2019, 2020 kind of thing. They want to look at all those kind of things. So you may need several years of financial statements. So you want to make sure that those are caught up, and that you're ready to be able to present that. They may want to see cash flow statements. So you may need time to prepare to make sure that you have those statements ahead of time. And then where to start, because sometimes you think like, I don't even know. So one good idea, when you're talking about succession planning and any planning really, is you really need to have a good idea of how much you want when you do retire. What are your current expenses? What expenses will you get rid of? Like, you may decide, I'm going to sell my principal residence. Um, and that may change. So think about what your current expenses are today. And then what are your expenses, 5 years down the road or 10 years, like when you retire? What other sources of income do you have coming in? You'll have your old age security, you'll have Canada pension maybe. What are those numbers roughly? And you can estimate today, but then what other expenses do you have? You may want to take trips. You may want to do some traveling. Do you still have a mortgage? Do you have savings? What do you have sitting in your RRSPs? What happens when those change over to a RIF at the age of 71? How much money do I have coming in at that point? All of those factors, um, will contribute to where you're starting from, how much you want to get out of that business. Is it worth that amount? Is that feasible? Those are lots of questions you're going to ask yourself. But by running through this exercise and figuring out what exactly your expenses are, what your expenses will be in the future, it helps to give you a really good idea of how flexible your succession plan may be. You may have in your mind that you want $1 million for your business. Um, and then when you get going down this hole, you realize that hmm, maybe a million is, you know, you come up with an offer and somebody gives you, they say, will give you 750,000 for your business, and you think, no, I really need that extra 250,000, and you turn the offer down, but no other offers come around. And then you may think, maybe I should have, maybe I shouldn't have. But by knowing what your expenses are, you'll also be able to know how much you can deviate from that number that you've come up with. And you may say, you know what, 750K in my pocket today is much better than waiting. But I'm gonna, revert back to, it's like selling a house again. You may have a number in your plan. When you're selling your house, you may say, no, I need this number. 5 years ago, you had to be very flexible in that number because, you might not have got a lot of offers. And, or you may have got several offers in the last few years, which exceed what you had thought. So you have to kind of think about it in, you know, is that number enough? Can I survive with that number? Or am I willing to take that risk to wait for that perfect offer? Likely, there is the perfect person that will come along to buy your business. It's just maybe harder to find and it may take longer. So how long can you put off that retirement if you want to? Or do you want to retire today? You want to take that money and start retiring and enjoying your life. So those are things. And I'm just going to break because I've been doing lots of talking. Can you think of anything else that might? I'm going to open it up to you guys. You can unmute if you like. Is there anything else that you can think of that would change from a monetary amount or value that you can think of right now that, you know, might change your succession plan in your business? Any thoughts or ideas? You guys are all so quiet this morning. So we'll continue on. Where else to start is, you know, who would take over? There's generally three different people you want to consider. Is there a family member that may take over? And maybe that's two or three or four. It's hard to say. Maybe you have a key employee that would take over, or maybe that you're reaching out to a competitor or a third party. Sometimes it may be somebody just walks in the door and says, I would like to buy your business. Generally, that does not happen, but so you have to kind of start thinking about, who that person might be. And that might be, 10 years prior to your retirement. And a lot can change in that 10 years. So again, back to that flexible plan, you have to be able to keep all your doors and options open as you're transitioning from that working full time into that retirement. You have to look at the skills, the knowledge, and the interest of those people. And will that work? Does that fit into what your plan is and how you have um, you know, successfully ran your business? So it's always important to start with these two questions. It's always a good place to start. It gets the ball rolling, gets your thought process heading in the right direction. And you never want to leave your retirement to chance because, you've worked hard and long for many years and you want to be able to then enjoy your retirement and not worry about every penny that you're spending, or not think that you can take that trip of a lifetime that you've waited for. And it's nice to be able to know that you have the flexibility and capability of doing that. Um, Without, just thinking, "Oh, I hope I'm lucky enough to have someone to come and buy my business." Just a few more interesting facts that I've thrown in here is that 30% of family-owned businesses make it to the second generation. Only about 13% make it to the third generation, and only about 3% make it to the fourth generation. So, you may feel like you've got a family member that may take over your business, but, in the majority of the cases, that's not the case. It's someone outside, which involves a bit more planning. Um, so now we'll get into kind of what are your options. You've decided on, you know, who that business is going to go over to. Um, what happens next? How do you do that? So passing ownership of your business to the next generation is obviously, popular. You're familiar with that person. They know that they've kind of have the same morals and ethics that you do. Definitely the family can benefit from leaving that business legacy. But sometimes that, as we've talked about, very difficult in some cases. The family complexity can change. You may have a daughter that you absolutely love to death. You think, perfect, she's the perfect person. She may end up marrying somebody who doesn't maybe fit in with the family dynamics, is a little bit off the wall. How do you look at that? There are certain things then that you need to really consider. If it's a family member that you're taking over and you want to protect that, you want to protect your children if they're the ones taking over. Um, and then you want to also be able to consider and think about, are you gifting it to them? How do you make that fair? Is that part of their inheritance, or are they paying for it? Are they paying what an outside person would pay for it? And that all needs to be thought through and documented accordingly to make sure that that plan works for any other children that may not be part of the business. And then, um, you know, making sure that's communicated with them and that they all know that that plan is there, so it avoids for having issues down the road. And then you also want to think about what your role will be in the next generation. It could be that they're transitioning in slowly. They may take over a portion of your common shares in the business, but they may not take over the full amount of common shares. Um, so what will they own? How much ownership will they have? Will they have control of your company? Are you ready to pass that on to the next generation? Or do you want to do it slowly and transition slowly? So those are all, things that you want to consider as far as your options go. Um, for many business owners with one child, those decisions become more complex. Um, a business owner wants to be fair to all of their children. And how do you do that? There's many different ways, and here we talk again about, remember that fair does not mean equal, and what you think might be fair might not be fair to a child not being part of the business. So there's certain things you can do. You can do an allocation of different shares within the business, and it may be that some of those children aren't even in the business, but they're going to get an annual cut. If you have a very successful business, that might be attractive and that might work well and might be something that would work, and that goes specifically to your own children. You may have children in that have the right skill set to move forward, and how do you offer them employment? They have worked elsewhere and then want to come into your business. So those are all things that you need to consider. Um, and then sometimes with the more complex corporate and family structures, it's often very helpful to, again, make sure that you're getting your advisors involved. Um, and yes, that can be costly, especially upfront costs, but the planning, and then presenting that plan to the family members, communicating that, it's all part of that transition and making sure that you're getting the best bang for your buck, that you've really worked hard to build that business up. So you want to make sure that, again, you're getting the most out of it. And what works best for you, we did a business plan not too long ago, and dad decided that his son was struggling with the business. The business changed a little bit over COVID, and he had a number in mind that he wanted to get out of his business. We had set that up, and then he came back and said, you know what, I want to gift the rest of them too. We're doing just fine. We don't need the extra business. He's really struggling being able to pay me, and I want to do this. So we need to transition this, but how do I deal with, this was the son in this case, how do we deal with our daughter? How do we make that equal for her? Because now we've just, decreased that value. So sometimes it has to be able to be, we go back to that flexibility. Um, and it's very interesting that 95% of the rising generation leave their parents' advisors once they have the power to do so. So you may have an accountant, a lawyer that you're dealing with. And it's interesting that your kids have different thoughts than you do. And as much as you want them to think about things being the same, chances are they're not going to. And it may take time. It just may be, some cases it's maturity for them. It's sometimes it's that, they can do things better or in a different way than mom and dad can. And it may not even be a different way. It may not be it's just a different thought process that they're going through than what you've gone through. And sometimes it's, I find that it's you've done the same thing for the same number of years in the same way. That sometimes it's just thinking outside that box and it's bringing in that fresh new thought process that can help as well. Because lots of times we can be um, looking at one thing one way and not really looking at it in a different way. And I often think I read a story one time about a small fly, and the fly is in the window trying to get out, and it's really flapping its wings and doing everything it can. And it's basically on its deathbed because it's, trying to get through this window, which it never will get through that window, and it keeps trying and trying and trying. But if he had have just turned around, there's a whole room and then an open door that he could turn around and fly out of. So sometimes it is about just opening our eyes and listening to others, listening to other family members, and being patient and being able to think that think that process through and having an open mind. Um, so now we're just going to touch on if you're transitioning over to a key employee. Um, you know, some business owners have a group of dedicated employees who have helped to build the business throughout the years, and you maybe want to, pass that over to one of them as you're considering retiring. Under this option, you will want to know whether that group or that person has the skills to run the business. Um, but must also consider whether they have the ability, the desire, and the willingness. They may not want to take on the stress of being a business owner, because we all know there's lots of days where it can be very stressful running your own business. They just may not want to do that, so it's important to have that conversation with them. Um, so that's basically what we're talking about here, is making sure that you talk to them, and they may have one price in mind, you may have another. So it's important to make sure that you're talking in the same apples to oranges kind of thing. You want to be make sure you're all on the same page, and that they're not thinking, oh, I can walk in and buy this business for 200,000 and you want 2 million. There's a big difference there. So it's important to start those conversations. How that buyout will look, how long are you going to stay there? Is it over time? Is it they're going to take over? What kind of control do they have? They may be one of those people that are like, yeah, maybe I do, but I want to run it on my own. I don't want you coming in here telling me every day how to, that the coffee has to be on at 8 o'clock in the morning, whatever that may look like, or that certain things have to be done a certain way. Um, they may not want to deal with that. So this one may be a little more emotional, maybe a little more, you have to talk through it. You have to really consider all options. This is where you have to really pull in your patience and listen to what their thoughts are. It may go perfectly well as well. If you work for that person long enough, they may think it's a great opportunity, and the transition goes very smoothly. And then if you're selling the business to a third party, you want to make sure that, especially in this option, that they're allowing you to profit from the success of the business. You want to make sure that you're getting everything out of the business that you can. You're not going to leave any portion of your retirement to a third party, whereas you may consider that if it's a key employee, or if it's a family member that you're transitioning down to. This can be challenging to find the right buyer. This may take time. You may have to have additional advisors come in to help you. Um, And you have to be able to trust that this person will run your company the way that you want it to be run. So this one will take a little bit more time, I feel, than the other two options. However, sometimes when the right buyer comes along, you'll be prepared. You need to make sure, like we talked about earlier, that you have 3 years of strong financial statements. Um, and that these statements will be key to the sale because that's really what they're going to look at. You may have to go get a business valuation done, um, and that can be costly. That will take some time to do that. But you want to make sure that you're completing that with due diligence because that's how you're going to get the most value out of your money is you're going to have to prove to this outside person that this business is worth what you're getting. So, you're going to want to make sure that you have the time and take the time um, to be able to do this. And usually, this one, you're going to end up getting the most value, but you're also going to be putting some time and effort into getting that business valuation done, making sure that you don't have excess cash sitting in there, making sure that everything that you want out of that business, you may have a piece of machinery that's in there that you want to make sure you take out prior to. Um, and then, will you sell the assets? You might just want to sell certain portions of your business as opposed to selling the shares of your business. How do you know how much it's worth? And that's where you'll sit with your advisors and they'll be able to help you to determine what is the best structure for you. I mean, generally when you're selling, you want to sell the shares of your corporation, but there may be reasons where you don't want to do that. So, let's talk about that. How will that whole structure work? What will the payments be? So as you can see, there's so many things that you're going to want to be able to consider. Um, especially in this plan itself because it's not like you could come back tomorrow. They may just say no, we're taking over on, October 31st, you're done, you hand over the keys and everything. So, and if it's been like a business or, like I think about my parents' house, for instance, there's a ton of things in there and you can't just, get rid of that in a month's time. There's going to be some planning and some involvement into that. So just kind of going over some of those points. I know I've talked a lot. Hopefully, I haven't bore you all to death, or you're not sleeping. Hopefully, you grabbed a coffee before we all started. But consider all your options. Have an open mind. Um, you know, and all of the options can provide you know, and keep a component of control in your hand or be paid out over time. So in each of those, there's going to be some planning that can happen. You can, and that's all done through the shares of your corporation. So the way your shares are set up is very, very important. So you may want to maintain some of the classes of voting shares. You may end up with some share redemptions, which means you're taking out the profits that you've made in that company. You're doing an estate freeze, and that you have a promissory note from the company that is paid back to you in time. Again, make sure that you're looking at to all your advisors. You're getting all the advice that you can possibly get. Um, you know, yes, that may cost you some money, but in the end, that may also, if we look at the tax savings portion of it, there may be other things that come up. They may have connections that you may not have considered. They may be able to put that key employee or that third party um, person in your hands because they may have connections with someone who's looking to buy a business, those types of things. And always remember if there's conflicts that arise even between family members, there's lots of specialists in that field that can come in as mediators to help out. So if you're worried about starting a plan because you know that there's going to be conflict, just go ahead and start it and then get the help and support that you need because there's lots of people in that field that can help out. And the most part about anything really is communication and updating information as it becomes available and having that conversation. And one other point is that you want to make sure that your wills are updated, your estate plan coincides with what your business plan is. And if something happens to you that, you know, that you're looking after that and your estate has planned for that. So if you have shares in a corporation, you want to make sure that those shares are covered in a secondary will. What do you want to have happen to those shares? If those shares are handing over to your spouse, then you want to make sure that that's covered off, and you can minimize taxes by doing that. If that's not done, then what may happen is you end up at date of death with a huge tax bill, because all of a sudden those shares that you own in a corporation worth $1 million are deemed to be disposed of at date of death. So just always keep those things in mind, and reach out to your advisors for any help. There's lots of tools and resources that are out there in order to help you. So thank you for listening. We're now at 8:24. So I just wanted to thank you. I know I've talked a lot, so hopefully that was
Actually,
some good information.
that's fantastic, Karen. I do have a quick question.
Yeah.
Tax benefits. You talked a lot about tax benefits for large, like incorporated businesses. What about the mom and pops out there who may or may not have an incorporated business or shares in a business?
Yeah, so looking at that is a little bit different, as opposed to shares in a small business. So if they're not incorporated, it's a completely different plan. And lots of times then you're looking at selling assets because you obviously don't have shares to sell. So it's looking a little bit different. And that becomes more part of your estate planning as opposed to, a business plan and a complete succession plan within a business with those shares.
Okay. So are there any tax benefits for
Oh,
me?
for sure. Yeah.
Okay.
Yeah. 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 So it's important to talk to your advisors about that.
Okay. Thank you.
You're welcome. Any other questions?
Okay, everyone. I have added Karen's information to the chat, just so if anyone wants to contact her. I see she's also got it up on the screen. I'd like to thank everyone. Thank you, Karen, for it was a great presentation. And thank you, everyone, for coming, waking up at early in the morning to attend this session. And if you're interested in attending any additional sessions, just visit shelburne.ca. Everyone have a good day. Bye-bye.
Thank you so much. Bye bye.